How do I create an income-generating strategy with a covered call? Investors who already hold stock positions can utilize a covered call strategy, which involves selling a call option on a stock that is already owned. This is akin to creating dividend income on the stock holdings, especially when some of the stock doesn't pay a dividend. The added advantage of covered call is this is not treated the same as dividend income and hence not taxable. As the stock is already in their possession, the investor is covered, or protected. In the event where the stock price increases and the call options expire in the money, the seller of the covered call would be obligated to sell the stock at the strike price specified in the call options contract. To help with your understanding, here is an illustration of how covered calls work. John bought 100 Tesla shares at $255 per share. He then decides to sell a call option at $10 with a strike price of $265 with an expiration date of 1 month from now. This means that John will be receiving a total premium of $1,000 for selling the call option. There are 2 scenarios that could play out for John. Scenario 1. Stock price below strike price $265. If the stock price is below the strike price, the call option will expire worthless for the buyer. In this case, the seller, John, will keep the premium collected from selling the option and retain ownership of the shares. John will also have the option to roll forward the contract by opening another covered call, a strategy known as the wheel strategy. This flexibility is another reason why covered calls are popular, as investors can continuously generate income through the sale of call options while holding onto the shares they wish to keep. Scenario 2. Stock price above strike price $265. If the stock price rises above the strike price, the call option buyer may choose to exercise the option and buy the shares at the strike price from John. In this case, John is obligated to sell the shares at the strike price but keeps the premium collected. This would amount to $265 per share plus $1,000 premium from the covered call. It's important to note here that the potential downside of using a covered call strategy is the limit of John's profit potential should the stock price continue to rise beyond $265. Nevertheless, investors can always buy back the shares if the price drops. By employing a covered call strategy, an investor generates income by receiving the premium from the sale of the call option. Referencing from the previous example, the investor can sell a call option with a strike price of $265 and they would receive a premium of $1,270. Investors needs to understand the time decay of options. Time premium is the portion of an option's premium that is associated with the time remaining until the option's expiry, and it diminishes as time passes. To take advantage of this time premium when selling contracts, it is important to note that there is a period for exponential time decay, typically within a period of 30 days to 45 days. The graph shows an accelerated rate of time decay as the expiration date nears. Understanding this graph allows a call option seller to thoroughly evaluate the risk of holding the option through periods of uncertain market conditions. This assessment aids the seller in deciding the optimal selling price and managing the possibility of an assignment for the option. Covered calls remain a popular trading strategy within options, providing investors with the means to realize profits in the prevailing market environment. They are generally considered a conservative strategy suitable for investors who are looking to generate additional income from their stock holdings while mitigating some downside risk. Stay tuned for more tutorials. Trade options with Poem's Mobile 3 app. Talk to our options specialists at 6531-1225 for assistance. Your partner in finance since 1975.